Volatility is an opportunity, but it's definitely one that's got a lot of pain associated with it, especially when you look at valuations. The market's down 8% yesterday and 20% across the board in the past few weeks. So is it a buying opportunity? Well, it is, but we'd be very careful. Certainly, what's happened is that ETFs have gone from being buyers pushing momentum, so pushing the momentum trade, to net sellers, which has destroyed the momentum trade, and now it's turned into a fully blown stock picking environment. So what we're doing is we're picking off stocks, very small parcels. Caroline and I are buying a small portion of our capital or putting a small portion of our capital to work, and we're looking to make money over the next 3 to 5 years. So in my opinion, you'd be crazy not to be looking for stocks if you've got a 3 to 5 year sort of return time horizon. Well, at Under the Radar report, we've been pushing quality companies. The last issue, we numbered 10 of them. So these are good stocks to start with, to have a look at, to feel comfortable with. These are stocks that we feel can weather the storm. And I guess when you're buying, you buy small quantities. We think it's a sensible strategy. You don't want to be panicking. You want to be just holding your nose and buying, but not buying too much. There is a lot of disinformation out there, that's for sure, but people also are aware of a lot of information, which is that the coronavirus or the COVID-19 is a reality. And you can buy toilet paper all you like, but you're not going to make money out of it. You are looking at a situation where the baby is being thrown out with the bathwater, so there are buying opportunities. But right now what we've seen is that there's been a confluence of forces. So economies are shutting down, important economies like Italy. Interest rates are being cut. The oil price is in free fall because Saudi Arabia is once again trying to take on the higher cost, debt-laden North American fracking industry in a bid for market share. So all this combines to kind of produce a situation where people don't know what the value of companies are. So our job is to look at the fundamental values and to remember that for the long term there are buying opportunities, but you have to be very careful. The long term is very important because in the short term, or in the most recent short term, we've been telling people to take profits, and the risk assets are definitely a place where you've needed to take profits. But on the flip side of that, for the long term, we think that their valuations are underpinned. That's on a 3 to 5 year environment, and that's because central banks are stepping in. Now, central banks are stepping in and providing interest rate cuts. The Fed cut 50 basis points, the Reserve Bank cut 25 basis points, and this is like similar around the world. So other central banks are cutting, and these central banks are going to be stimulating the economy through quantitative easing. Even here, we're going to see quantitative easing, and that's going to have basically an effect of pushing up or keeping asset prices high over the long term, because low interest rates mean high asset prices. Why do we get low interest rates? We get low interest rates because there's a general savings glut, and the authorities, namely Greenspan in 2000, and then more succinctly under Ben Bernanke, are very aware of this global savings glut, and I guess their policies are around stimulating the economy are going to help the risk assets the most. And those risk assets that are the most affected by it, or the most helped by it, are the riskier end of the risk assets, which, you guessed it, are small caps. Well, the banks have been hit harder than almost any blue chips, because not only have we got their profit growth under question through slowing global economic growth, but I guess we've got their profitability in question as they pass on these interest rate cuts, so their net interest margin gets reduced. But I guess what you've got to remember is that the banks in Australia in particular are very strong because of regulatory mandates that have force them to increase their capital requirements. So basically, these banks are very strong. The biggest risk factor in banks is whether their mortgage margins get crimped. And we don't see that happening anytime soon, because after the financial crisis, we saw non-bank financial lenders go by the wayside. So the banks are in a very strong competitive position, and we're going to be doing a full report on the banks in our blue chip issue this week. And I think the main message is to stay calm and to look to pick up banks at cheap prices.